Part 1, Section D, Cost Management. So here they're going to study about costing, cost accounting, different types of methods available for costing, and procedures, accounting system, different names. We're going to study one by one. Right? So before we proceed, the term cost, costing, cost accounting. What is cost? What is cost? So the amount I'm going to receive for exchange of a product or exchange of a service is called cost for me. I'm going to buy something. It's a cost for me. I'm going to buy the service. I'm going to buy any product. It's called cost. So the exchange, you're going to exchange money that you're going to pay to buy a product or getting a service is called cost. What is costing? The system which is going systems and procedures applicable for a product or service is called costing. What is cost accounting? So it's ascertainment of cost for a particular product or services by using the accounting principles, management accounting principles called cost accounting. So these are the basic three terms. Right. So before you proceed, right. So generally, any component you're going to manufacture or any service you're going to render, it consists of three components. One is called material, another one is called labor, another one is called overheads. So these three components only constitute cost plus profit is equivalent to sales. Suppose I have a mouse, it consists of material component, labor component, and the other expenses. Overheads, factory related expenses, office related expenses, selling related expenses, distribution related expenses. So those kind of indirect expenses are called overheads. So material, labor, overheads means cost. Aggregate of material, labor, overheads, we just adjust, will be getting cost. Then you have to add a profit, then you'll be getting a sale. That's a basic idea. Right? That's a before we proceed, I'm going to say some basic idea. Suppose, for example, I have a mouse. The mouse is going to be cost $80. $80 cost. Cost of manufacturing cost of sale $80. That is middle component, labor component, overhead component cost. For example, material is going to be $30. Labor component is going to be $20. And overhead is going to be $30. Overall cost is going to be $80. So profit I'm going to add. I'm going to add the profit. It's going to be $20. The sales is equivalent to $100. The cost to profit is equal to sales. Right. Now, that's a trick say I'm going to apply everywhere in application orient. When I'm starting MCQ, I'm going to apply this model. The profit is equal to $20. That is equivalent to 25% of cost. 25% of cost. Can you check it out? What is cost actually here? In example, $80. So 25% of 80. Right? That is equal to profit 20. Profit. Or 20% of sales. 20% of sales or revenue. What is sales figure here? It's going to be $100. So 20% of 100. That's it. So 80 into 25%. Please do the math. 80 into 25% is nothing but 20. Please do the math. So 80 into 25% is going to be 20. 100 into 20%, that is equal to 20. Therefore, profit is equal to 20. That's it. So mathematically, they are equal. So 25% of cost is equal to 20% of sales. That is equivalent to profit value. I'm telling one more time, 25% of cost is equal to 20% of sales. That is equivalent to profit 20. Right. Still, okay. So 20 in the given example, 25% of cost. So 25% of cost, that is equivalent to 20% of sales. That is equivalent to 1/4 of cost. That is equivalent to, if you simplify, 1/5 of sale. 1/4 of cost, 1/5 of sale. 20 under 120 paisa, 420 paisa. 120 is 520. Simple math calculation. So profit is equivalent to 1/4 of cost. That is equivalent to 1/5 of sale. That's a basic idea we studied in the earlier classes. The profit is equal to 1/4 of cost. That is equal to 1/5 of sale. Both remain same profit. So 25% of cost is equal to 20% of sale is equal to same number, 20 only. 20% of 80 or 20% of 100, both same number, all three same number. So profit is equal 1/4 of cost or 1/5 of sale. Okay. Similarly, profit is equal to suppose 1/3 of cost. What about in terms of sales? It is going to be 1/4 of sale. See, 1 plus 4, 5. 1 plus 3, 4. 1 plus 3, 4. 1 plus 4, 5. So 1/3 of cost is equal to 1/4 of sale. 1/4 of sale. That's a trick. Suppose 1/2 of cost, which is equivalent to what proportion number of sale is going to be 1/3. 1/3. 1 plus 2, 3. 1 plus 2, 3. That's a trick. 1/2 of cost is equal to 1/3 of sale. 1/3 of sale. So profit is equivalent to suppose 1/6 of cost. What about in terms of sales? 1/7 of sale. 1 plus 6, 7. 1 plus 6, 7. 1 plus 6, 7. Suppose profit is equal to 2/5 of cost. 2/5 of cost. What proportionate number of sale? 2, 2, 2, 2 plus 5, 7. 1 plus 6, 7. 2, 2, 2 plus 5, 7. So 2/5 of cost is equivalent to 2/7 of sale. 2/7 of sale. That's a trick. Okay, right. Suppose 15% of 15/100 of cost. What proportion number you have to multiply to get the same value of sales profit? 15, 15. 15 plus 100 is equal to 100. 15 plus 100 is equal to 100. 100. Similarly, profit is equivalent to 15 by 80 of sale. What proportionate number you have to multiply with the cost to get the same profit? 15, 15. 15, 15. 80 minus 15, it is going to be 65. 80 minus 15 is going to be 65. So that's a trick. So profit is equal to so 33 1/3 percentage of cost. What percentage of sale is? That's it. So 33 1/3. 33 1/3. 1/3 of cost. See, if you're going to divide 100% into three components. Each component is going to have 33 1/3, 33 1/3, 33 1/3. 33, 33, 33, 99. 1/3, 1/3, 1/3, 1. So 99 plus 1, 100. So 33, 33, 33, 99. 1/3, 1/3, 1/3, 1. 3, 1/3, 1. So 100. So 33% of 100, which is equivalent to 1/3 portion only, correct? No? So 33 1/3% of 100 is equivalent to 1/3. Both are same. So you're going to represent in terms of 100, it means 33 1/3% of 100, or you can say 1/3, 1/3. So profit is equal to 1/3 of cost. 33 1/3% of 100 means 1/3 of cost. We're going to divide 1 into three components. It is going to be 1/3, 1/3, and 1/3. That's it. 1/3 of 1 is equal to 1/3. So 33 1/3% of 100 is equal to 33 1/3. That's it. Both are same only. If you're going to divide 100 in terms of three components, each component represents 33 1/3. If you're going to divide 1 in terms of three components, 1/3 of portion is equal to 1/3. 1/3 of cost, that is equivalent to 1/4 of sale. 1/3 of cost is equivalent to 1/4 of sale. 1/4 of sale. That is equivalent to same amount of profit. 1/4 is nothing but 25%. 1/3 is nothing but 25%. So 25 by 100 is equal to 1/4. So that's a trick. So either way they can use. Suppose 33 1/3% of sale. What percentage of profit? So 33 1/3 is equivalent to 1/3. I told you 33 1/3% of sales or 1/3 of sale, both are same. 1/3 of sale is equal to 1/2 of cost. 1, 3 minus 1, 2. 3 minus 1, 2. That's it. So 1/2 of cost is equal to 50% of cost. 50% of cost. So 50% of cost is equivalent to 50% of cost is equal to, so 33 1/3% of sales. So 50% of cost is equivalent to, so 33 1/3% of sale. So that's a trick. So we're going to apply this concept in all MCQ models. So both remain same profit. 1 by 2 of cost, 1 by 3 of sale. 1 by 3 of cost, 1 by 4 of sale. 1 by 5 of cost, 1 by 6 of sale. That's it. 1/9 of cost, 1/10 of sale. 2/5 of cost, 2/7 of sale. 2/3 of cost, 2/4 of sale. Just like this. That's the idea. That's it. Let's start with cost sheet. Cost statement or cost sheet. Cost statement or cost sheet. Okay. This is a cost sheet. Okay. So generally, I told you there are three components in a cost: material, labor component, and overheads. Okay, fine. So first one, number one, direct material. Direct material consumed. Direct material consumed. So that is equivalent to opening raw material. So before we start any production, generally we have raw material available, correct? No? So there are three stages. First one is called raw material. Number two, working in progress. Number three, finished goods. That's it. Raw material component, work in progress, and finished goods. Any production. These are the three stages. Raw material stage, work in progress stage, and finished goods. So input, process, output. Input is raw material. Process, work in progress. Output is called finished goods. So first, before we proceed, what is direct material consumed? Which is nothing but opening raw material plus any purchase of raw material, or means raw material, plus carriage inward of raw material. It means, so we have to pay freight expenses, carriage inward of raw material. Okay, plus carriage raw material minus closing raw material minus, so closing raw material minus sale of scrap of raw material. It's a normal loss. So generally, direct material consumed, opening raw material, purchase of raw material, carriage inward, freight inward we have to pay to bring the material to the present location. Please add it to the material cost minus closing raw material minus sale of scrap of raw material. Suppose any scrap produces out of raw material, it has to be sold of a revenue we are generating. We have to subtract from the cost. These are all cost. Sale of scrap of raw material is a normal loss. The normal loss, any scrap produces from the cost you have to subtract. That's it. So sale of scrap or raw material. Generally, when you're handling, but definitely there is a loss supposed to be happening. Any scrap produces, if it is sold in the market, revenue we generated, it has to be subtracted from the cost. That's it. So this is called direct material consumed. Opening raw material, purchase of raw material. Please memorize carriage inward minus closing raw material minus sale of scrap of raw material, normal loss, which means you cannot prevent. That's it. So traceable. You cannot prevent it. That's it. So if there is any revenue generated out of the scrap, it has to be subtracted from the cost. So it's called direct material consumed. Number one, direct material consumed. Number two, direct labor or direct wages. So direct labor or direct wages. To bring the material to the present location, so what will be the expenses involved? So labor, traceable. So if it is a traceable, direct labor. That's it. So any labor expenses we incurred for production, okay. Suppose, for example, directly traceable, direct labor. So paid, how much amount you paid for labor? Salary, wages, plus it. Is there any outstanding available? Minus. Is there any advance payment did? Minus prepaid. Is there any advance payment did? Minus prepaid. So paid plus outstanding minus prepaid is equal to direct labor or direct wages. That's it. Paid plus outstanding minus prepaid. Similarly, number three, direct expenses. If anything other than material and labor are called direct expenses if it is a traceable direct expenses. For example, machine hiring charges, machine hiring, assets hiring charges, or royalty and production. So these are formula I'm using. I'm going to pay royalty to you, royalty and production. So these expenses are called direct expenses. Example, machine hiring charges, royalty and production, direct expenses, traceable expenses. Here also, how much amount you paid for direct expenses? What is outstanding you're having? Minus prepaid. That's it. So the balance you have to put it there. Direct expenses paid plus outstanding minus prepaid. So if you're adding all the three, which is 1, direct material consumed, plus number 2, direct labor, plus number 3, direct expenses, you'll be getting prime cost. The term is called prime cost. In costing, the terminology, it is called prime cost, or it is called direct cost. So prime cost or direct cost. Prime cost or direct cost. Traceable cost is called direct cost. Right. If it is not traceable, indirect. If not traceable, indirect. Exactly, you cannot precisely measure those expenses, but there are supporting expenses supposed to be incurred, but cannot be traceable. Indirect expenses called overheads. Overheads. First overhead, factory overheads. So add. So prime cost we know. So the prime cost, please add factory related overheads. Factory related overheads. Or work related factory overheads or work overheads. Both are same only. Both are same only. So interchangeable terms only. Factory overheads or work overheads. If you add factory overheads, work overheads, what is factory overhead? Expenses incurred in factory. Non-traceable. Factory supervisor salary, factory rent, factory power, factory lighting, factory machine depreciation, anything related to factory expenses, factory overheads, or work overheads. So generally overhead means, overheads, they used to call OH. OH means overheads. Abbreviation for overheads, OH. Overheads means aggregate of indirect material, IM, plus indirect labor, plus indirect expenses. So it is called overheads. Direct material, direct labor, direct expenses, prime cost. Indirect material, indirect labor, indirect expenses, overheads. That cannot be traceable. But expense supposed to be happening, but you cannot trace it. Exactly, precisely, you cannot measure it. Indirect. So aggregate of indirect material, indirect labor, indirect expenses, overheads. So all factory related overheads, please add to the prime cost. You'll be getting gross factory cost, or gross work cost. To this, so prime cost plus factory overheads, gross factory cost. Prime cost plus factory overheads, gross factory cost. Please memorize. To this factory cost, add opening work in progress. Please add. And closing work in progress, please subtract. The closing work in progress, or work in progress, what it may be, please subtract. Okay. For example, today's closing, tomorrow's opening. Today the process is not going to be completed, so tomorrow will continue. That's it. Or weekend we are not supposed to close it. Next time we can open it. That's it. So last day's work, next day's opening. Or last month's closing, next month's opening. Just like this. So for work in progress, it is always under production. Okay, the product is under process now. So add work in progress opening, subtract closing work in progress. You'll be getting net factory cost, or net work cost, So net factory cost or net work cost. So gross factory cost plus add opening WAP minus closing WAP, you'll be getting net factory cost and net work cost. So to this, add office and administrative related overheads. Office salary, office rent, office expenses, office table depreciation, office computer depreciation, all office related expenses, office and administrative related expenses, office and administrative overheads. Please add all office related expenses. Please add. You'll be getting cost of production. If you have a factory, you need a office also to manage this. So cost of production, COP. Cost of production is called COP. To this COP, cost of production, COP. To this cost of production, add opening finished goods. Minus the closing finished goods. Opening finished goods minus closing finished goods. Generally, finished goods also stock opening, stock closing. Stock opening, finished, stock closing. That's it. Adjust opening finished goods and subtract closing finished goods. Add opening finished goods and subtract closing finished goods. So you'll be getting cost of goods sold. The term in costing terminology is called cost of goods sold. COGS. Cost of goods sold is called COGS. COGS. Cost of goods sold. The cost of production plus opening finished goods minus closing finished goods is equal to cost of goods sold. COGS. To this cost of goods sold, add selling and distribution overheads. Selling and distribution overheads, which means selling expenses, distribution expenses, selling and depreciation, salesman commission, salesman salary, distribution man expenses, distribution salary. That's it. Distribution, whatever be the related expenses of selling and all selling and distribution overheads. If you just add, you'll be getting at the term, it is called cost of sale. So then only the cost of the product of the mouse has been arrived at. The cost of sale is equivalent to, I told you, no, here $80. See the previous example, I told you, no, $80. That's the cost. Here the cost arrived at, per unit cost $80. So this cost of sale, add profit $20, you'll be getting sale. You'll be getting sale $100. That's it. So this is the cost of sale. This is the way the cost has to be ascertained. Profit to be added. Sale is going to happen. There's a complete cost sheet. I'm going to segregate in later. When I'm solving MCQ, I'm going to segregate. What is the middle consumed value? What is COGS value? What is COP value? What is COS value? So what is the sale amount? So these kind of tricks I'm going to apply. So let's see. Next one, cost behavior. Okay. Cost behavior and cost object. Okay. So theory, we're going to explain the concept thereafter. Okay. Cost behavior, how the cost is going to behave. What is the cost object? What is cost assignment? So cost assignment means process of tracing the direct cost and allocating the indirect cost. I told you, traceable are called normal, direct. Non-traceable, example, supervisor salary, you cannot trace it. But worker assigned to the product, labor we can identify. But supervisor, one day is working in one department, another department is working, we cannot trace it. Okay, for maintenance oil, any oil expenditure for maintaining a plant, no, you cannot measure it exactly. So non-traceable, those costs are indirect. Traceable are called direct cost. So cost assignment is a process of tracing a direct cost. That's it. What is cost objective? That's it. It is an item or activity which is a separate and discrete measurement of cost. That's it. So cost can be product wise, function wise, department wise, division wise, contract wise, service wise. That's it. So operating cost is called service costing. Operating costing or service costing. That's it. Operation costing or process costing. In service costing, generally contract costing. Contract cannot be completed within a year. It will take 3 years or 4 years. So how the profit has to be recognized by the contractor. So contract costing. In service oriented, suppose what is per mile cost? I'm just going to the freight company. I'm asking them, so what is this is a load. You're going to transfer from this place to this place. How much you're going to charge, sir? I'm asking. They're telling, so per kilometer we are charging $100. So for 10 kilometers, it's going to be $1,000. How the $1,000 is derived? Service cost. So transport department, they're using service costing. Flight company, they're using service costing. Based on the service costing only, they are charging you the flight tickets, train tickets, bus tickets, freight expenses on lorry. I mean the transport system. So cost can be assigned, cost can be measured product wise, function wise, department wise, division wise, contract wise, service wise. So cost can be assigned for the following reasons. So cost is nothing but measurement of assets and income for financial reporting purposes. It can be useful for measurement of assets and income for financial reporting purpose also cost to be assigned. And the cost has to be capitalized for income tax purpose, which means the cost has to be added to the asset. That's called capitalization of cost. There are some costs which has to be capitalized. For example, asset purchased, capitalization cost. Machine purchased, capitalization cost. Machine development added to the cost. So capitalization of cost, which means simply added to the asset. Okay, right. That's called capitalization of cost. So once capitalized asset cost has been capitalized, you can charge depreciation. Once you charge depreciation, so automatically what happens means your profit can be reduced. So by the way, tax you have to pay less. That's it. So the more and more we capitalize, the higher we can take depreciation. That's the idea. So finally, you have to pay less income tax. Similarly, you have to pay cost of producing units of goods. What is the cost of producing 1 unit? What is the cost of goods sold per unit? That's it. And other relevant costs for decision making. There are some costs which are very, very useful for the decision making purpose. Cost which is going to be useful for decision making purpose is called relevant cost. Cost cannot be used for decision making purpose. It's called sunk cost. Sunk cost cannot be useful for decision making. The cost which is going to be used for decision making is called relevant cost. Relevant cost. What is cost allocation? So cost has to be assigned. Okay, cost has to be assigned. Cost has to be allocated to this product. Cost has to be allocated for this product. This product is going through 5 departments. Then the product is emerging out. So cost has to be ascertained. Cost has to be assigned, allocated. Right? For this, we have a cost pool. Cost pool is nothing but factory related overhead expenses, selling related expenses, office related expenses, administrative related expenses, factory related expenses called cost pool. Okay. Similarly, all the indirect costs cannot be traced, but it can be allocated to particular head. It is called pooling. Factory overhead. Cost pooling example, factory overhead. Selling and distribution overhead, S&D overhead, S&D overhead, S&D overhead. Similarly, office and administration overhead. That's it. So non-traceable, cannot be traced, classified into category. It's called factory overhead expenses. Selling and distribution expenses, office and administration expenses. That's called cost pool. Next one is called allocation base. What is allocation base? So it is allocation base measure used to allocate cost, pulling dollars into cost object. So please allocate cost pooling. Okay. So there are cost and effect. So cost can be categorized into functional wise, variable. I mean, it's going to be variable cost and fixed cost, functional wise. Variable cost and fixed cost. For example, factory rent I have to pay. That is purely fixed cost. Whether you're producing or not, but you have to pay factory rent every month. Factory supervisor salary fixed. The respect of output you're producing, that is fixed cost. What is variable cost? Generally material, labor, variable nature. See, this is 1 unit, 1 material, 2 unit, 2 material, 3 units, 3 material, 3 labor. Correct? No, that's called variable. So the more and more you're producing, more and more variable cost will happen. Fixed cost remains always same. So function wise, it can be decided, it can be allocated into various. So it's going to be variable cost and a fixed cost. That's it. So you have to allocate, you know exactly what is variable cost, what is fixed cost. I'll tell you later on those areas. So similarly, allocation base is called cost driver. Cost driver may be anything. It can be charged to the product or it can be charged to some departments. It's called driver. So allocation base, department wise, product wise is called cost driver. Next one. So behavior point of view, cost can be classified into variable and fixed. Variable and fixed. That's it. So generally, within a short time, the activity level is going on in the production area of a long term and short term. Right. For example, short term also fixed and variable cost is going to happen, and long term also variable cost is going to happen. That's it. So generally, long term means variable cost. Variable cost. Okay, sometimes fixed cost also long term is going to happen, but short term means fixed and variable. That's it. Short term means fixed and variable you have to analyze. Long term also variable and fixed cost you have to analyze. So within a period of 9 months, what is the fixed cost? What is variable cost? Suppose I'm going to produce 1 million mouses for this year. 1 million, my target. So what is fixed cost going to be incurred? What is variable cost going to be incurred? For shorter period, what is the fixed cost? What is the variable cost? And why there is a variation of the cost that we have to analyze. We have to budget it. Budget is very, very important. Family, if you want to run, you need budget. Similarly, production or any company you're going to run now, you need budget. You need budget. So cash budget you have to prepare. Cost budget, master budget, middle budget, procurement. So many budgets are available. And you have to find the variances also. Why there is a variation? I estimated actual. Why there is a variation? Estimated cost 100, but actual cost 110. Why it's happened? I have to analyze. Estimated cost 100, actual cost 120. Why it's happening? I have to analyze. So that's called analyzing the variance. So functional wise, the cost can be categorized into variable cost and a fixed cost. Variable cost and fixed cost. That's it. For example, what is variable cost? I told you for producing this mouse, I need material, I need labor. One mouse, one material, one labor, 1 unit of labor, 1 unit of material, and 1 unit of something. That expensive. Okay, 1 unit are required. That's it. More and more produce, more units required. For 1 mouse, 1 unit, 2 mouse, 2 units. It's called variable. Variable. More hours required. Variable. 1 hour cost, but 2 hour cost variable. 1 unit cost, 2 unit cost variable. Variable cost is always variable, always variable, always variable. So variable cost per unit, variable cost per unit fixed. Variable cost per unit fixed. So total variable cost variable. For example, one mouse variable cost, one mouse variable cost is going to be $100. 10 mouse, 10 into $100, that is equal to $1,000. So variable. But variable cost per unit fixed. Total variable cost variable. Suppose 20 mouses, 20 into $100, that is equal to $2,000 variable. So more and more mouses you're producing, more and more variable expense is going to happen. It's going to be 1 mark, MCQ model, variable cost per unit fixed. So total variable cost variable. But what about fixed cost? So whether you're producing or not, you need to have a fixed cost, fixed rent, fixed salary, you have to pay. Fixed salary, it's called fixed cost. It's called fixed cost. That's it. Whether you're producing or not, you have to pay fixed cost. That's it. Suppose I'm producing 100 units. What is fixed cost? $1 lakh. $1 lakh. Suppose I'm producing 1,000 units. What is fixed cost? Same $1 lakh. What is the rent you have to pay? $1 lakh. Same rent, same salary. If you're producing 100 units, what is the rent you have to pay for the factory? Same $1 lakh. Suppose you're producing 1,000 units, so what is the rent you're going to pay for the factory? Same $1 lakh. So total fixed cost remains constant. So total fixed cost is always constant. Total fixed cost always constant. But fixed cost per unit variable. Fixed cost per unit variable. How to differentiate? For example, 100 units you are producing. Fixed cost $1 lakh. $1 lakh. Is a fixed cost. What is 1 unit fixed cost? 1 unit fixed cost. 1 unit fixed cost $1 lakh by 100. That is equal to $1,000. $1,000. That is going to be $1,000. What is 1 unit fixed cost? Fixed cost per unit $1,000. What is fixed cost per unit? $1,000. $1,000. Okay, right. So fixed cost per unit $1,000. Right. Next, suppose you are producing 1,000 units. What is fixed cost? Same $1 lakh. Same $1 lakh. What is 1 unit fixed cost here? $1 lakh by 1,000. That is going to be 100. Correct now? So fixed cost per unit changes. So fixed cost per unit variable. Total fixed cost constant. Variable cost per unit fixed. Total variable cost variable. That's it. So functional wise, cost can be categorized into variable and fixed. That's it. Let's see decision making. Cost may be classified based on the relevance, decision making point of view. Relevant cost. Any cost which are very useful for decision making, those costs are called relevant cost. Example, incremental or marginal cost. So marginal cost means cost of producing one additional unit, marginal cost. The cost of producing one additional unit is equal to marginal cost. Suppose you're going to produce one additional unit. What is the cost involved? Incremental cost or marginal cost. So this cost is very useful for decision making purpose. That's it. The cost which cannot be used for decision making purpose is called irrelevant cost. Whether the cost existing or not, it is not going to be useful for the decision making purpose. Example, sunk cost. The cost which is already incurred, it cannot be useful for any purpose. Sunk cost. Cost, that's over. So cost which cannot be taken for decision making process called irrelevant cost. Cost which is going to be taken for decision making process, relevant cost. What is the opportunity cost? There are two events, mutually exclusive. But one you have to choose at the cost of other. It's called opportunity cost. The one you have to choose at the cost of other. That's it. Mutually exclusive means either this or that you can choose. Not both. Suppose one you are going to choose, now the other you are going to sacrifice. So the cost of selecting the next best alternative is called opportunity cost. For example, you're a cost economist. You're working in a company. You're getting $1 lakh salary per month. Okay, fine. Or maybe salary per annum, maybe $1 lakh per annum you're getting salary working in a company, right? Suppose you're going to resign the job. The other option, you can go for practice. You can start, you can go open an office, you can employ somebody else, you can start an office, you can practice it. Suppose you're going for practice, the amount you're going to collect from the clients is supposed to be only $30,000 first year or $20,000. But salary you're getting per year $1 lakh. You're going to open and practice it. The salary, the fees you're going to get from the client is going to be $20,000. 1 lakh salary, 20,000 fees if you open an office. But what is the opportunity cost you are having? Cost of sacrificing your job, $1 lakh, no, that is going to be opportunity cost. That's it. Okay, the cost of sacrifice. So mutually exclusive. Either you have to go to office, either you have to go to as an employee, as a work, or you can open office. So either you can practice it or you can go for employment. Mutually exclusive. But you cannot choose both. Only one you can choose. The best alternative going to sacrifice is called opportunity cost. That's called opportunity cost. Let's see. What is manufacturing cost? Manufacturing cost. So manufacturing cost means cost related to the materials. Example for finished goods, including packaging. Okay, right. Which can be feasible and cost effective to produce traceable to the product per unit basis. Direct material. I know exactly how much material has been involved in this product. Direct material, traceable, including packaging also. Material converted into finished goods. I know exactly what is the price and package cost, traceable per unit to direct material. If it is non-traceable, indirect material. Factory materials, indirect. Office material, indirect. Selling, indirect. You cannot trace the cost exactly, precisely, indirect. You know exactly, precisely, direct. So direct material means the following things are direct, including the direct material cost. So from your vendor, supplier, invoice price, discount received. The invoice price is added to the material cost. Sales tax you paid for the material. No, if there is no credit, If there is no credit, it is added to the product. Sales tax paid for material, added to the cost. Duty paid, added to the cost. Because I'm just importing from China, I paid some dollars import duty. So you have to add? Yes, you have to add. So to bring the material into present location, what will be the cost involved? Please add it to the cost. Customs duty paid, added to the cost. Delivery cost paid to the vendor, added to the cost. Delivery container charges, added to the cost. Minus refunds. So for container, the material is coming. So after taking the material out of the container, materials are returned back to the supplier. He refund just refund the deposits back to me. Then that is to be adjusted. Non-refundable containers added to the cost. Refundable containers, deposits refunded to be subtracted. So once the material taken out of the containers are going to be refunded, just going to be returned back to the supplier. Upper is going to refund the money for the container that is not added to the cost. Non-returnable container cost added. Returnable container cost, by the way, the amount will be getting back from the vendor, that is to be subtracted. So these are the things added to the middle cost. Let's see. Direct labor. What is direct labor? Labor cost involvable in the labor cost incurred for the product, traceable direct labor cost. Can you effectively trace the cost? Yes. Can you effectively attach the labor cost to the product per unit? Yes. Those costs are called direct labor cost. Compensation paid for the worker, manufacturing product, labor involved for this product. Bonus is involved. Traceable, yes. Any social security taxes we paid. Generally in USA, we have to pay social security taxes for each and every employee. Suppose he is unemployed, generally social security coverage will be there. You'll be getting some amount from the government. Some subsidy will be getting. You'll be getting some remuneration. Okay, unemployment benefits will be getting. That's called social security taxes. Cost of living allowances. That's called used to call DNS allowance. DA. Used to call DNS allowance. Cost of living allowances. So place to place, DA will be higher. And USA cost of living will be very higher in California, very low in Miami or Texas, very high in California, very high in New York City, Miami, Texas, very low. So, but DA will be different from place to place. That's it. Because of the federal tax. So, cost of living allowances, traceable, please add it to the labor cost. So, the other items are most difficult to, more difficult. So, they relate to specific units of labor, but it can be included in the direct labor. More difficult to locate, but they try to be included. If it is known, please include. Direct labor, included, to be included. Health insurance paid for the employee for this manufacturing. So, employee manufacturing this product. Insurance paid. Can add it to the cost, labor cost? Yes. Group life insurance? Yes. Holiday vacation pay? Yes. Pension benefits to the employee and post-retirement benefits, yes. Permanent compensation expenses, yes. More difficult to locate it, but to be, if it is known, not to be added. If it is known, not to be added. Unemployment taxes paid by the employer, yes. So they are all traceable, specific to the product. So if they are traceable, then please add to be included in the direct labor cost. Okay. So premium paid for overtime work, special shift work, holiday work. They are all indirect labor, but they included as a manufacturing overhead unless such work related to the specific product. So generally, any overtime expenses for the special shift is added to the special product only. It is a part of manufacturing overheads. Okay. Upon new job we are getting, our labor are new to this job. Our more labor hours required. Automatically, because of new job, our people are not skilled. Definitely our production, generally is going. What happens? A new job generally declines as production increases. So more and more units going to produce now. So automatically it's going to decline because the number of labor hours is going to be increases if production, because our labor hours needed for the new job generally declines if production increases. It's a function of learning curve, which means if you are a new employee, initially you need more hours. The more and more experienced, you need less hours. First time I'm seeing the job, I need 10 hours. Second time the same task, 9 hours. Third time 8 hours. Fourth time 6 hours. So one fine morning, the learning curve is going to be zero. So the experienced person, learning curve is going to be 0. The learning curve is applicable only for the unskilled or any new job coming to the business production unit. Still you are not ready to be trained. So it's a learning curve. Initially learning will be higher. Then you're getting experience. The automatic learning curve will drifting to 0. That we'll see later on. Learning curve. So anything indirect labor will be charged to manufacturing overheads. Right. So indirect material. So these are the materials used in the manufacturing process. So they do not become part of the product. Example, solvents, cleaning fluids, that's it. They cannot exactly know. So generally, we are using the factory solvents. No, we cannot exactly measure what is the price. You know the price, but exactly you cannot charge. You cannot allocate. Non-traceable. Cleaning fluids, solvents, you cannot exactly trace it. So they do not become part of the direct, they become part of the indirect. So they're not direct material, they're indirect material. Similarly, we cannot know paint involved, painting done in the factory, varnishes, nails, screws, but not cost effectively traceable. I don't know exactly what is the paint traceable to the product. I cannot trace it. Varnishes involved, nails involved, screws involved. I cannot able to exactly trace it. So those are going to be indirect. So non-traceable, indirect, traceable, direct. That's the only difference. If it is non-traceable, it's a part of factory overhead. Non-traceable, part of office overheads. For non-traceable, part of selling and distribution overhead. Similarly, indirect labor. Labor involved, but you cannot trace the labor exactly. Example, janitor. I mean the keeper. Okay, the keeper. Okay. So the storekeeper or whoever maybe the godown keeper, janitor. Janitor service you cannot measure exactly. Exactly, you cannot charge to the product. Exactly, you cannot trace to the product. Plant security personnel, material handling operator, janitor, inspection worker. You cannot exactly measure it. Labor cost cannot be effectively traced. It's called indirect labor. So these are the components of manufacturing overheads. Manufacturing overhead. Okay, right. So manufacturing overhead. Okay. So if not traceable, please add it to the manufacturing overhead. That's it. So manufacturing supervisor salary, exactly manager salary, managed salary. So manufacturing supervisor salary, manager salary. So technically indirect labor does not include manufacturing supervisor salary. Indirect labor means cost cannot be effectively traced to the product. That's it. Cannot be. That's called indirect labor. So manufacturing supervisor salary is a part of manufacturing overhead. Manager salary, part of manufacturing overheads. Okay, which means so janitor services, plant security personnel, material handling operator, inspection workers. Exactly, you cannot trace it. Indirect labor. But manufacturing supervisor salary, manager salary, part of factories. Office supervisor, office salary, part of office overheads. Selling and distribution of expense, related expenses, selling S&D overheads. That's it. Then you indirect labor to be classified according to the nature, sales related, office related, manufacturing related. So those related, those related overheads you have to charge. Overheads. So manufacturing overheads, factory overheads, it's a burden. That's it. So it's a cost other than direct labor, direct material. So it's called overhead. I told you what is overhead. Abbreviation for overhead is called OH. OH means overheads. Aggregate of indirect material, aggregate of indirect labor, aggregate of indirect expenses. It is called overheads. Overheads. Not directly traceable to the specific product. That's it. Specific product. Called overheads. Collectively called overheads. Indirect variable cost. Indirect variable cost related to material. Indirect fixed cost related to depreciation of fixed factor. Indirect means both will come. Indirect variable cost available, indirect fixed cost also available. Indirect variable cost example material, indirect material. Indirect fixed cost example depreciation of factory plant, or factory rent, or office rent. Selling it is fixed expenses. All overheads, fixed expenses are called indirect fixed expenses. Indirect fixed overheads. I told you prime cost. What is prime cost? So prime cost, one more name, it is called direct cost. One more name, direct cost. I earlier told you cost sheet. Cost sheet. So direct cost or prime cost is equal to aggregate of direct material plus direct labor plus direct expenses. Prime cost or direct cost. What is overheads? Aggregate of indirect material, indirect labor, indirect expenses. Non-traceable overheads. Traceable direct. Traceable direct. Non-traceable indirect. What is conversion cost? Conversion cost excluding material. In conversion cost, no middle cost, no middle cost. So conversion cost means technically, the conversion cost means technically direct labor plus direct expenses plus factory related overheads. That's it. Factory related overheads. No middle cost involved in conversion cost. Please memorize, no middle cost involved in conversion cost. So conversion cost means direct labor, direct expense, the factory overheads. So no middle cost involved in conversion cost. That's it. So let's see what is raw material inventory. I told you earlier cost sheet. The component of cost sheet is called raw material consumed. That will consumed. That will consumed including packaging. Including packaging. Okay, right. Including package also will be taken into consideration for raw material consumption. See, generally, whenever the raw materials are not stored in the inventory, the concept of production system is called just in time. It is a Japanese system. Okay, just in time. When the just in production system is implemented, no storage of raw material required. Straight away, your vendor, your supplier, straight away deliver the material to the factory floor directly. So 10 o'clock your production starts. 9 o'clock material arrived to your factory. Vendor straight away supplying material to the factory. Those concepts are called just in time. 9 o'clock means 9 o'clock, not 9-1. 9 o'clock. That's 9 means 9, not 9-1. So this is just in time. In Japanese, the time so conscious. 9 means 9, not 9-1. 9 means 9. That's it. If you just go to the railway station by 9-1, the train left. Arrival time 9 o'clock means 9 o'clock. Departure time 9-2, 9-2. If you just coming to the station by 9-4, sorry, no train left. Just in time. So such a punctuality they are maintaining in production system. So no storekeeper, no raw material requirement, everything straight away delivered to the factory floor by the vendor. This concept is called just in time. In case of just in time, minimum amount of the inventory we have to maintain it to avoid the stock out. The minimum. If there is no just in time production system available now, you need storekeeper, raw material, inventory controller, everybody required. Just in time production system implemented now, there is no storekeeper required. Small inventory you have to maintain it. So in order to avoid the stock out cost, that's it. That's the alternative. GAT is alternative to raw material inventory. Alternative raw material inventory system is called GAT system, just in time system. So 10 o'clock production starts. 9 o'clock vendor will supply to your factory. That's it. There is no storekeeper required. There is no raw material things are required. That's it. Okay. Just come back to raw material inventory. Apart from GAT, if not GAT, stock inventory required. That's it. So what is opening raw material? Opening raw material plus purchase of raw material. Here I'm going to take only direct. I'm going to take only direct labor, direct minus closing of raw material is equal to direct material consumed. I told you minus sale of scrap of raw material also. Minus sale of scrap of raw material. If there is any scale of scrap or raw material, normal loss available, that is to be subtracted. It's direct material consumed. Opening raw material plus purchase minus closing minus sale of scrap is equal to direct material consumed. RM consumed. I told you first portion, RM consumed. So let's see. My WP control, I told you the part, okay. So direct prime cost, factory overheads, gross factory cost, I told you, right? So work in progress. Okay. So after gross factory cost, add opening work in progress less closing work in progress is equal to net factory cost. With this, office and administrative overheads, please add. You will be getting cost of production, cost of goods manufactured. That's it. Okay, right. So raw material consumed, direct labor, prime cost plus factory overheads, add opening WIP minus closing WIP. Will be cutting cost of goods manufactured or cost of production. Sometimes before office, sometimes there are two opinions. Before office it is called factory, after office it's called production cost. Here the overhead means it is including factory overheads, factory as well as office also sometimes. Office also. Okay, office administration required to maintain the factory. So that is also part of manufacturing cost. To maintain the factory, we need office. So that is also sometimes office administration also will be categorized into cost of goods manufacturing. That's it. So that's the cost of production or cost of goods manufacturing. So gross factory cost, opening WIP, closing WIP, adjust net factory cost, add office and administration overheads, that is equivalent to cost of production. That's it. Similarly, next one, cost of production we know. The cost of production, add opening FG, subtract closing FG, that is equal to cost of goods sold. Please go and check the cost sheet I told you earlier. So finished goods inventory. How to find finished goods inventory? What is cost of goods sold value? So cost of production plus opening finished goods minus closing finished goods. So cost of production plus opening finished goods minus closing finished goods is equal to COGS. Cost of goods sold. Cost of goods sold. That's it. Please go and check the cost sheet. Please memorize the cost sheet. Right. So there are two tiers of inventory system normally used in manufacturing and production related areas. One is called perpetual inventory, another is called periodical inventory. So what is perpetual inventory? Year end they will take the inventory. That's it. How much inventory they have in records, how much inventory physically available, how much inventory has been sold out. So they will go and check it out periodically. Year end they will do. It's a periodical system of inventory valuation. That's it. What is the material has been stocked in the year end as per records, physical verification. What are the goods available? What are goods has been sold? So balance is stock. They will check it out. So periodically they can verify the inventory. Is called periodical system. In case of perpetual inventory, so it's a continuous stock taking. Receipt, issues, balance, receipt, issues, balance, continuous stock taking. Perpetual, continuous stock taking. That's it. Acquisition material entered, reacquisition entered, transferred, my sub issued, balance updated. Now everything has been computerized nowadays. So widely used. I know the stock opening. So any adjustment today added, anything sold, balance. Opening, addition, sold, balance. Opening, addition, sold, balance. So this kind of continuous stock taking is called perpetual system. That's it. It's called perpetual system. So periodical system to be done. Year end we are going to compare stock available, physical verification, records, goods sold. Periodical system. In case of perpetual, very simple, system oriented, continuous stock taking, opening, receipt, issues, balance. Opening, receipt, issues, balance. Openings, receipt, issues, balance. Just like this, continuous stock taking. Everything has been automated nowadays. Okay, it's very easy for you. You can just press of a button. No, you can able to exactly know what is stock available. So perpetual system. So continuous stock taking. So by taking the continuous stock taking, what happened now? So the error and fraud can be minimized. That's it. So that is the only thing. You can exactly check what is the accuracy of the system. Okay, any shrinkage of inventory we can easily identify by using this system. Any stock has been stolen or theft, okay, immediately we can identify using the perpetual system. But there are two types of inventory. One is called periodical inventory. Year end they go and value and physically verify stock recording. They'll compare. to find the amount, to find the number of units sold, in perpetual day-to-day basis. Day-to-day basis comes in, so issued balance, comes in, issued balance, perpetual system. Here the theft and other things controls are more established. In periodic perpetual system, more control established. So this is the pattern of cost flow in an organization, manufacturing area. Number one, so purchase of material, labor material payment, and factory overheads, and the overhead to be applied. WAP, work in progress. Material purchase, labor purchase, factory overhead applied, work in progress, and finished goods. So balance is cost of goods. So balance is cost of goods. That's it. So just the cost sheet, cost of flow. Cost sheet, cost of flow. That's it. So material, labor, overheads, work in progress, finished goods, then finally cost of goods. The cost of goods sold plus selling and distribution expenses, cost of goods sold plus S&D expenses, selling and distribution overheads, you will be getting cost of sale. So cost of sale plus profit is equal to sale, is equal to sale. Same cost sheet, just like cost flow chart format. What is actual cost and normal cost? What is actual cost? What is actual cost? Actually, what is the direct material cost involved in terms of labor and dollars? What is the actual direct labor cost? What is the actual factory overhead cost? What is the actual factory overhead cost? That's it. What will be the amount we incurred? It is called actual costing. Actual material purchased, actual labor cost incurred, actual overheads incurred. That's called actual. Estimation is called absorption plus standard costing. Estimation costing or standard costing or absorption costing. That is estimation. Estimate material required, estimate labor required, estimate overheads required. That's called estimation or absorption. This is actual. This is actual. This is actual. So there are two more concepts I'm going to explain here. One is called actual. Another one is called estimation. Another one is called estimation. Another one is called estimation. Estimation, actual. There are two concepts. Estimation E, actual A. Suppose estimated material cost $100. Actual material cost, it is going to be $120. $120. Okay, fine. If estimated material cost less than the actual material cost, correct? No, it is called under absorption. It is called under absorption. Under absorption. Generally, under absorption means there is a loss, variation available. There is a variation loss. See, we estimated middle cost supposed to be 100, but actually it is incurred at 120. Extra amount we incurred. So it's a loss for us. Loss. It is called under absorption. If estimated less than actual, the concept is called under absorbed. The difference will be treated as a loss, costing point of view. Suppose if estimated more than actual, it is called over absorption. It is called over absorption. Anything labor, overheads, material, same concept. Material, labor, overheads, same concept. Under absorption or over absorption. Over absorption. Suppose estimated cost. Cost means general estimation only. Suppose estimated middle cost $120. Actual labor, actual middle cost or labor cost, overhead cost. Say for example $100. Estimation will be more than the actuals. It is called over absorption. Here the $20 is going to be, you can charge to profit. Profit. If estimated more than actual, it is called over absorption. If estimation less than actual, it is called under absorption. Under absorption means loss. Over absorption means profit. That's it. So overheads generally to be estimated, and we are going to compare the actuals. So estimation, absorption, okay, absorption, applied, all are same. Estimation, absorption, applied, standard, all are same. Standard, same meaning only. Standard, applied, absorbed, estimation, same, one and same word, but they can use the word often. Standard costing, applied costing, absorption costing, estimation, right? But actuals are different. So I'm telling one more time, if estimation is than actual or under absorption, estimation more than actual or absorption, that's it. Or absorption, profit. Under absorption, loss. That's it. So costing means always estimated. That's it. Concept, normal costing. Normal, abnormal. Normal loss, abnormal loss. Normal leakage, abnormal leakage. Normal wastage, abnormal wastage. So normal cost to actual cost. What is normal? Normal. So normally you are going to apply direct material, direct labor, valued at actual cost. But generally, overheads are applied on a normal basis. Generally, in organization, costing system has been established. Overheads will be, overhead means indirect expenses, will be applied on average on a normal basis. So overheads are applied on a normal basis. Middle cost involved actuals, labor actuals, overheads normal basis. Estimate overhead cost to be divided among the production hours. That's it. Okay. So I'm going to tell you here. For example, in a factory, the factory overhead expenses are $100,000, $100,000. So $100,000. Okay. Factory hours, $10,000, 10,000 hours. So 10,000 hours, factory hours, or mission hours, mission hours. Mission hours, $10,000, 10,000 hours. Factory overheads, $10,000. What is factory overhead or work overhead per hour? Per hour. Per hour. That is equal to $100,000 by 10,000 hours. 10,000 hours. $100,000 by 10,000 hours. So $100,000 by 10,000 hours, that is equivalent to 10. That is equal to 10. $1 1 hour is equal to factory overhead per hour is equal to $10. 1 hour factory overhead is applied, estimated or normal 10. Overheads are applied at normal rate, the applied rate, applied. Estimation applied. What is factory expenses per hour? $10. What is factory overheads? $100,000. What is factory hours involved? 10,000 hours. What is per hour factory overhead? So factory overheads numerator, machine hours denominator. Similarly, labor hours. Suppose in a factory, machine dominating, so machine hour based. Labor dominating, labor hour based. Units dominating, unit based. So factory overhead per unit, factory overhead per labor hour, factory overhead per machine hour. Machine hour, that's it. So this is per hour based, per machine hour based, per labor hour based, per unit based. So factory is going to be applied on the basis of machine hours involved in the factory, labor hours involved in the factory, units involved in the factory. That's it. This factory is applied. Upper, we have to develop standard costing. So in a standard costing system, standard costs are developed for all inputs per unit of production. So general inputs cost, we are going to charge to inventory. In input cost, material input, charge to the inventory. So number of units that should have been used to make per unit of product. See, per unit of product, what is the cost involved? Cost involved. Okay, of a number of inputs added per 1 unit of output. 1 unit of output. That's the input cost. Input, output. Suppose 3 units of input applied to get 1 unit of output. So 3 units of input applied per unit of output. So generally overheads can be charged on the machine hour based, machine dominating, labor hour based, labor dominating, unit based, unit dominating. That's it. So you have to find out the number of hours. So overheads are generally on estimated basis only. So that's called factory overhead rate, machine hour rate, factory overhead based on the machine hours, factory based on the labor hours, factory based on the units. So what is per unit factory overhead? Estimated. What is per labor hour factory overhead? Estimated. What is per hour per machine hour overhead? Estimated. Similarly, variation. By comparing the standards with actuals, you have variation. The variation may be favorable or unfavorable. If it is a favorable, it is called F. If it is unfavorable, it is called adverse. So favorable variances, adverse variances, positive variances, negative variances. That's it. So they're going to be charged to the cost of pools. So what kind of overheads? Selling related overheads. Our selling related. Fixed related, fixed. Pull into fixed. Variable related, pull into variable. Okay. Selling related, pull into selling. Distribution related, distribution. Office related, factory related. So pulling to fixed. What is fixed overhead cost? Irrespective of output, this is the amount it is going to be incurred. Irrespective of output, your level of activity will differ, but this fixed overhead you have to fixed. It is always fixed. Okay, irrespective of production level activity, it is always fixed. It do not vary with the production activity. Even if you're going to produce 100,000 units, it will not vary. Even if you're going to produce 10,000 units, it will not vary. Example, depreciation, rent, storekeeper salary, janitor services, production supervisor salary, building depreciation, rent, factory rent, fixed. Anything fixed, respect of output is fixed overhead. Anything variable is called variable overhead. So more we produced, more variable, more material, more labor, more variable overheads. That's it. It is going to vary with the level of production activity. For 1 unit, this is the cost. For 2 unit, into 2. For 3 units, into 3. Variable overheads. That's it. Power, electric power, machinery. 1 machinery used, 1 machinery current charges. 2 machinery used, 2 machinery power charges. 3 machine used, 3 machine power charges. It is variable. Next. So plant wise, department is overhead cost pooling. So plant wise, you have to segregate some cost overheads. Department wise, you can charge. That's it. That's called departmental overhead. General overhead, department overhead. So in traditional system, you have to accumulate all the overhead expenses based on the plant or department. Traditional system, not a modern system, traditional system. So traditional system, all your overhead expenses to be accumulated. Please accumulate and charge on the plant. Charge on the plant wise, charge on the department wise. That's it. So your production will be divided into activities performed by the department. Suppose this mouse has to coming out of different departments. Of different departments, the overheads are involved. That's it. Of plant wise, department wise, overheads involved. Of different managers in different departments responsible for controlling overheads. So factory manager responsible for factory controlled overheads. Similarly, A department manager responsible for A department overhead cost responsibility. So each and every department headed by the manager to control the overheads. Every organization, they are always looking for reducing the overheads only. Ultimate aim, reducing the overheads. So why you have to cost to be incurred? Please pass the benefits to the customers. Reduce the overheads, pass the benefits to the customers. So volume wise, you can make a sale extra. Of allocation basis, we can able to allocate to different departments. That's it. The department cost, each and every suppose mouse is going to be incurred in 4 departments. Our different department costs is generally preferred to plant wise pools. This department, this plant, please allocate. The departments to be attached to the plant wise, or okay, that's a basic. Normally, plant wise we can do it, or process wise also. Right? So everything we need break overhead cost. That's it. Break-even point we required. Break-even point. What is the break-even point to be achieved? So break-even point, if you want to achieve now, definitely no profit, no loss region. So ultimate aim, you have to achieve the break-even point. Beyond break-even point, you have totally profit only. That's it. So it is desirable to achieve the break overhead cost to pull down. That's it. Within the department, each and every department, the overheads to be break-even, you have to achieve. That's it. Beyond break-even point, we're going to produce profit. So break-even point to be established. Next, traditional allocation basis. Generally, all the overheads in traditional product costing system, including labor hours, labor dollars, material dollars, mission hours based. Okay, right. So allocation basis per hour mission overheads, per dollar, per material, in terms of percentage, in terms of labor dollars, labor percentage, in terms of labor hour, in terms of material percentage, in terms of mission hour. That's it. So traditionally we can allocate. For example, if you want to understand now, for example, factory overheads, $100,000. Mission hours, for example, 1,000 hours, 10,000 hours. What is factory overhead? Per mission hour is equal to $100,000, sorry, by 10,000 hours. 10,000 hours. So 10,000 hours. $100,000 with 10,000 hours. So 1 hour factory overhead is equivalent to $10. 1 hour, 1 mission hour factory overhead equal $10. Similarly, we can put labor hours also. The factory overhead based on the labor hours. Same factory overhead numerator, $100,000. Labor hours involved, 10,000 labor hours involved. So factory overhead based on labor hour is equal to same $10. Okay. Factory based on mission hour, $10. Factory based on labor hours, $10. Denominator labor hour here, denominator machine hour. Machine dominating, labor dominating. That's it. Suppose factory overhead based on the units. So that is equal to factory is numerator, units denominator. Suppose $100,000 is equal to your factory overheads. So 10,000 units you produced. What is per unit factory overheads? $10. So $10. Per unit factory is going to be $10 per unit base. Sometimes percentage based. Okay. For example, so factory overheads based on the middle cost in terms of percentage. Suppose factory cost is equal to $100,000. So middle cost is going to be, for example, $20,000. So 5 times, which means factory is based on the middle cost of 5 times. You can say per hour $10, per unit $10, just like this. So 5 times your factory overhead is in terms of middle cost 5 times, or you can say in terms of percentage also. In terms of percentage means factory overhead denominator, middle cost or labor cost numerator into 100. Suppose middle cost is $20,000. Factory overhead is $100,000. So $20,000 by $100,000 is equal to 20%, which means factory cost 20% middle cost. In factory cost, middle cost can be 20%. So these are the ways you can allocate. So factory was in terms of middle cost, factory was in terms of labor cost, factory was in terms of direct expenses, factory cost by middle cost in terms of times, factory was by units per unit cost, factory was by machine hour per machine hour cost, factory was by labor hour per labor hour machine cost. So factory is going to say in terms of labor hour, in terms of machine hour, in terms of units. Let's see, overhead application rate or allocation rate or blanketed used to call. What application rate or allocation rate? That's it. Overhead has to be allocated in different ways. The actual overhead application rate. That's it. Actual overhead application rate and the predetermined overhead application rate. There are two things. Predetermined application rate. So sometimes what happened? No? So actual overhead, this rate is calculated by dividing the actual overhead cost, by the actual volume of allocation base. So actual how much units you produced, what is the overhead cost? You divide. That's it. That's called actual overhead application rate. That's it. Okay, right. So overhead cost in numerator, denominator actual volume you produced. How many units you produced? Divide it. We'll be getting actual. You'll be getting actual overhead application rate. Predetermined rate. Here it's going to be. What is overhead cost? Numerator. What is the estimated volume is going to produce it? What is the estimating volume you're going to produce it? Denominator. That's it. This is predetermined overhead. Suppose overhead cost is going to be $100,000. Estimated volume is going to be 10,000 units. अब 1 unit is equal to $10. Overhead cost $100,000. Actual volume you produced $12,000. 12,000 units you produced. Actual volume. 100,000 by 12,000 units. It is going to be 8.33 dollars. Let's see. There are two more terms. Already we discussed it. It is called under absorption, over absorption. I told you. The standard costing system also we have under absorption, over absorption available. What is under applied or over applied? What is underestimation, overestimation? What is under applied? What is over applied? All are same. Applied, estimation, absorption, all are same. Applied, absorption, estimation, over applied, over estimation, over absorbed, same. Under applied, underestimation, under absorbed, same. Both are same. If anything estimated cost more than actuals, okay, it is called over absorption. Estimated cost more than the actual cost, over absorption. Suppose estimation cost is $120. Actual cost is supposed to be $100. It is called over absorption. Suppose estimation less than actual. It is called under absorption. It is called under absorption. Under absorption. That's it. Under absorption. Estimation more than actuals, over absorption. Estimation less than actuals, under absorption. Suppose estimation is going to be $100. Actual is going to be $130. Under absorbed. Under absorbed by $30. Over absorbed by $20. Over absorbed by $20. Under absorbed by $30. That's it. Over absorption leading to profit. Under absorption leading to loss. Right. Next, generally, your budgeted cost and actual cost is always differ. So that's called inaccurate cost budget. 100% true. Your cost budget estimation not going to be tallied to the actuals. You're differing. So if actual production is equal to anticipated levels, your actual cost differ from the budgeted cost. That's it. Actual cost differ from the budgeted cost. Inaccurate cost budget. Similarly, inaccurate allocation base. Your allocation is inaccurate. Allocation inaccurate. Your actual volume and budgeted volume are different. Allocation based. Your actual volume is 10,000 units, or 10,000 hours, or $10,000. Your budget volume is more or less. Budget dollars are more or less. So it's called inaccurate allocation based budget. That's it. So the difference between the budgeted and the actual leading to production volumes are deviations from budget efficiency. That's it. Shows a deviation. So budgeted and actuals, the difference is called deviation. That's it. Let's see. Disposition of under or over applied overheads. Disposition of under or over applied overheads. Okay. How the overhead absorption to be adjusted? Fine. Any under applied or over applied, periodically we have to close it. So typically it will be transferred to COGS. See, for example, amount is not material. If the amount is not material one, the adjustment is adjusted to COGS, cost of goods. Suppose the amount is relatively large, it should be prorated basis, the please charge. Work in progress, finished goods, and cost of goods, please charge. Based on applicable already in each account. That's it. Okay. So if not material, small amount charge to COGS. If the amount is huge, please pro rata basis, charge those under related or over related to WAP finished goods and COGS. WAP finished goods and COGS, please charge. I'll tell you an example how the under absorption, over absorptions are accounted. Huge amount, allocate the under absorption, over absorption in WAP finished goods and cost of goods. If the amount is not material, small amount, the entire amount charged to COGS. Big amount, proportionate, WAP finished goods, COGS. Immaterial, small amount charged to COGS. For example, I can tell you an idea here. How they're going to be absorbed between WAP factors and the COGS. XYZ company is highly automated machinery manufacturer, highly automated. Everything is automation. The company estimates period manufacturing overhead expenses. Depreciation $100,000, rent $50,000, utility expenses $35,000, supervision $10,000. The total $195,000. Estimated cost $390,000. Mission hours involved 90,500 mission hours involved. Okay, these are the given. Yeah, okay. So this is overhead cost. Rupees, $195,000. Middle cost $390,000. Mission hours 90,500 mission hours. So please calculate the overhead application rate at middle cost and mission hour basis. Middle cost and mission hour basis. That's it. Okay. Number one. Number two. Suppose this company, they took a job A. Job number A. They took a job. 900 hours mission hours involved. 900 mission hours involved. $20,000 of material involved for the job. For this job, you're going to produce 900 mission hours to be involved. 20,000 material required to complete the job B. Find the applicable overhead rate for this product. Allocation based on the middle cost, based on the mission hour. That's it. That's what they're telling you, right? First, you have to find the applicable rate. So overhead rate, I'm going to find out based on the material cost. I told you already how the overhead to be applied based on the material cost. Based on the material cost. I can say in terms of percentage also. In terms of percentage also. What is overhead cost? $195,000. What is middle cost? $380,000. $380,000. Okay. So your overhead denominator, your middle cost numerator into 100 you can say. Into 100 also. Percentage also you can say. Or per dollar also you can say. Suppose your machine cost, suppose your middle cost is $195,000. Suppose your factory, middle cost is $380,000. So middle cost is $380,000. The middle cost is going to be $380,000. Overheads, $185,000. $185,000. So middle cost overhead, how many times? 2 times. 2 times. So 390,000 by 195,000 by 195,000 is going to be 2 times or 200%. 2 times or 200%. 200%. 200%. Okay. Or we can say like this also. Like this also. Like this also. So overhead is a numerator. Middle cost is denominator. Overhead is going to be $195,000. Middle cost is equivalent to $380,000. Is equivalent to 0.5 times. 0.5 times. If middle cost is equal to $1, overhead is equal to $0.5. Middle cost and overhead is related by this formula. If middle cost is supposed to be $1, overhead is going to be $0.5. That's the relationship. You can say like this also. Or you can say 0.5 times. Or you can say 200%. Middle cost in terms of overhead is 200%. Or overhead middle cost is 0.5 times. If middle cost is $1, overhead is equal to $0.5. Either way, we can say that. Suppose concept number 2. Overhead using middle cost. Concept using material machine hours. There is only one concept. Overhead is always numerator. Machine hours always denominator. Overhead is equal to $195,000. Machine hours involved 19,500 hours. 19,500 hours. Machine hours 19,500 hours. Hours involved. So 1 hour what is overhead? $10. $10. That's it. So per machine hour, it's called overhead rate. Overhead rate. Here also overhead rate. In terms of times, in terms of variations, in terms of percentage, this is overhead rate. So about one per machine hour, $10. $1 machine cost means $0.5 overhead. Okay. So now first question is over. First question is over. Right. Allocation base, I fixed it. Second question, I took a job for 900 hours. 20,000 materials involved. Based on the middle cost, based on the machine hours, how we are going to charge the factory. Okay. So 9 hours first. 9 hours. So you're going to charge for 9 hours. 9 hours. See 1 hour. What is 1 hour? Overhead rate per hour. 1 hour if machine running, no? What is overhead cost? $10. 1 hour overhead. What is per dollars? 1 hour overhead cost? $10. $10. For the job, I took 900 hours. 9 hours. Our total overhead cost for 9 hours is 900 into 10. That is equal to $9,000. $9,000. $9,000 for the job. So based on the material, $1 material means $0.5 overhead. If $20,000 material, our overhead is $10,000. That's it. Off. Material overhead. If $1 material, $0.5 overheads. Suppose $20,000 for this job. For the job, I have a job. Up automatically, the answer 20,000 by 1 into 0.5 into 0.5. So that is equal to $10,000. So overhead charges $10,000. If material $20,000, overhead $10,000. Based on the machine hours, $9,000. Let's see. Assume that XYZ company incurred $180,000 of manufacturing expenses. Actual machine hours is 25,000. Actual machine hours is 25,000. Right. Suppose overhead based on the machine hour. Overhead based on the machine hour. Can I answer the first question? What is actual overhead based on the machine hour? Very simple. So machine hour rate is equal to your overheads, manufacturing overheads numerator. Your machine hours denominator. So machine overheads, your factory manufacturing overheads $180,000. Your machine hours 25,000 hours. The machine hours 25,000 hours. $180,000. But can you divide $180,000 by 25,000 hours? You'll be getting 7.2. 7.2. So you'll be getting $7.2. $7.2 will be getting. That's actual overhead. That's the first question. First question is going to be 7.2. Okay. So 180,000 by 25,000 hours is going to be 7.2. So 7.2 machine hour. That's first question. Or machine hour overhead expenses 7.2. First question. Second question. Assuming the variance is immaterial to XYZ company, what journal entry would be provided? Okay. What journal entry would you provide? It is immaterial. It is immaterial. It is immaterial. What journal entry you can provide? That's it. That's the question. Okay. See. So, 25,000 machine hours involved. 20 machine hours involved. Okay. See, already take the previous sum. Take the previous sum. Take the previous sum. Take the previous sum. Applicable rate is equal to that $10. The previous one $10. Okay. So continue the example. The example they continue. They continue the example. The previous sum also they taken into account. The previous sum they taken into account. Previous sum based on machine hour $10. $10. Okay. Right. $10 the previous one. Okay. So previous one applied overhead $10. Okay. This is actually actual overhead. This is actual overhead incurred. This is exact manufacturing expenses incurred. This is exact machine hours. Exact actual machine hours. Actual manufacturing expenses. Previous one estimated. This is actual manufacturing expenses. This is actual machine hours. Right. So actual machine hour rate is 7.2. Actual machine hour rate is 7.2. But estimate machine hour rate previous one is $10. Estimate machine hour rate previous one is $10. $10. Right. So this previous one is estimated machine hour rate $10. So $25,000, 25,000 hours, 25,000 machine hours actuals. That is to be multiplied with the predetermined rate. Already we calculated. Predetermined rate already calculated. That is equal to $10 per hour. 25,000 hours is $10 per hour. That is equal to 2.5 lakhs. So 2.5 lakhs. 2.5 lakhs. Please check it out. This is applied overhead. Actual hours is 25,000 hours. No doubt at all. Predetermined rate, applied rate is $10. Applied rate is $10. So 2.5 lakhs. This is applied overhead. But actual overhead $180,000. Applied overhead 25,000 into 10. Actual overhead 180,000. Applied overhead predetermined rate 20,000 into 10. So that is going to be 2.5 lakhs. So applied overhead 25,000. Actual overhead 180,000. Difference is variation. So actual overhead $180,000. Difference is $70,000. $70,000. Now tell me, here the estimation is more than the actual. What is estimated overhead? $250,000. What is actual overhead? $180,000. What is the difference? $70,000. Difference $70,000. If estimation is more than actual, it is called over absorbed. What is the costing what is the costing name here? Terminology? Over absorbed. So it is called over absorbed. Over absorbed is $70,000. $70,000. Okay. So over absorbed means the cost we have to reduce. Cost we have to reduce. Over absorption means cost we have to reduce it. So entry for this. So manufacturing overhead control account. So manufacturing overhead control account data to COGs that is equivalent to $70,000. Over absorption leading to profit only. Anyway, cost has to be reduced. Over absorption is leading to profit only. Anyway, the cost has to be. Anyway, this is estimation cost, actual cost. Finally, the control account will be closed by passing manufacturing control account data to cost of goods sold. Because the profit, so cost has to be reduced. So cost credited. Suppose under absorption, cost debited. Under absorption, cost debited. Over absorption, cost credited. Over absorption leading to profit. So cost credited. Cancelled. Cost cancelled. So manufacturing control data, cost of goods sold. So by the way, the 70,000 we can able to close it. Second part. Case 3. I'm telling one more time. If estimation is more than actuals, it is over absorption. If estimation is less than actual, suppose estimation is 1,000. Imagine actual is 1,000. In my example, if estimation less than actuals, under absorption. Right? Estimation under absorbed. Correct. By how much? $200. Is a loss? Yes. Actuals exceeding estimation, therefore loss. Under absorption, yes. Estimation less than actuals. Under absorption, yes. How much? 200. Number 2. Right. Loss, yes. 200 loss. Can you make an entry? Yes. Cost to be debited. So COG is going to data to manufacturing overheads. That's it. Cost to be 200. We'll come back to third one. Assume that variance is material, that applied overhead, estimated overhead, absorbed overhead, standard overhead, all are same. Applied, absorbed, estimated, everything same. Year-ending balances, WIP, $50,000. Finished goods, $100,000. Cost of goods sold, $350,000. How the amount of variance should be allocated to COGS? How the amount of variance to be allocated to COGS? Right. Here everything will be pro rata basis that we have to allocate. Pro rata basis we have to allocate. Right. I tell you how the pro rata is applied. How the pro rata is applied. What is WIP mark? $50,000. Right. What is finished goods? $100,000. What is cost of goods sold value? $50,000. What is total? $500,000. Ratio purpose. WIP value, finished goods value, COGS value. Ratio purpose. Right. So now. So what is under absorption here? $70,000. Under absorption here, $70,000. So $70,000. So under absorption, $70,000. Right. $70,000. Now it should be apportioned on the basis of WIP. Finished goods to COGS. So here, what is the amount of variance should be allocated to COGS? They are asking you. Correct? No, COGS is asking you. So the material, if it is a material, entire difference can be charged to COGS. Okay, and if it is immaterial, entire amount can be charged to COGS. If it is material and pro rata basis, you can transfer. That's it. There are two things available. Okay. So under absorbed, if amount is $70,000, immaterial, then transferred to COGS single entry enough. Transferred to COGS single entry enough. That's called manufacturing overhead to. So manufacturing overhead control account to COGS. That is going to be $70,000. That is immaterial. Suppose Same under absorption. Sorry, here it's going to be, sorry, here is over absorption. Sorry. In our example, it is over absorption. In our example, it's over absorption. That's simple. Okay. Suppose in our example, given over absorption is $70,000 because $250,000. No. See how we got estimation, actual. Estimation $250,000. Actual to $180,000. The difference is called over absorption. Over absorption, overhead, it's going to be $70,000. Difference. The difference $70,000. 250 minus 180, $70,000. This is entry. The amount of over absorption is immaterial. If over absorption amount is immaterial, then entry middle overhead to COGS. Suppose overhead absorbed is material, significant amount, then $70,000 pro rata basis you have to pay. Pro rata basis. $70,000 you have to charge pro rata basis. So pro rata basis is pre-charge. Pre-charge to WAP FG COGS. WAP FG COGS. WAP $50,000. FG $100,000. COGS $350,000. The total, so $500,000. $10,000. That's it. So pro rata basis. The pro rata ratio, 50,000, 100,000, 350,000, 350,000, 350,000, 50,000, 100,000, 350,000, 350,000. So 1 time, 2 time, 7 times. 1:2 is 7 also you can do it. You can do it. Or 50,000, 100,000. If you want ratio you can do it. Or percentage also can same 510,000 also you can do it. See for example, so $70,000 into 50,000 by 500,000 or 1/7 or 1/7. 50,000 by 100,000, 500,000, 50,000 by 500,000, or I can do 1/10, 1/10, 1 plus 2 plus 7, 10, 1/10. 50,000 by 500,000 or 1/10. Either way you can do it. Ratio wise or total wise. 50,000 by 500,000, 500,000. So 1/10, 1/10. 70,000 1/10, it is going to be $7,000. $7,000. So $77,000, please allocate it to first one is WAP. Similarly, $70,000, if it is a material amount, into 1,00,000, $100,000 by $500,000. Okay, 70,000 by 100,000 by 500,000. So 70,000 by 5 is going to be $14,000. We adjust towards finished goods. Same $70,000 under absorbed. Next, into COGS amount $350,000 by 500,000. So 70,000 into 350,000 by 5 lakhs. So 14 plus 7, 21, 49. 14,000 charged to COGS. So total $70,000 allocated to WAP, FG, COGS. The amount is material. Of entry here is over absorption only. Okay. So earlier we made an entry. COGS credited, correct now? Because amount is immaterial. So everything transferred to COGS. But suppose amount is material, now this is the idea. this idea. So amount is material. Upper to WEP account $7,000. To FG account $14,000. To COGS account $49,000. Here it is going to be under absorbed overhead. Under absorbed overhead account debited by $70,000. $70,000. Same model. See, if the amount is immaterial, na entire amount adjusted towards the manufacturing overhead control account or under absorbed, anything you can say, transfer to COGS. Suppose amount is material, significant, appo under absorbed overhead or manufacturing control. So it should be allocated on pro rata basis to WAP, FG and cost of goods. Either manufacturing overhead control you can debit or under the overhead you can debit. Both are same only working. So WAP finished goods, cost of goods, pro rata allocation. Cost to be cancelled in WAP, cost to be cancelled in finished goods, cost to be cancelled in COGS. If the amount is immaterial, everything will be transferred to COGS. Amount is material, pro rata basis. That's it. This is the way under absorption, over absorption to be adjusted. That's it.
Subscribe to our YouTube channel Stride Edutech and press the bell icon to see new videos.